It's widely known that banks profit by lending money that's been deposited by customers. A customer deposits a chunk of money at the branch, the bank holds onto it until someone applies and is approved for a loan, and the money is then lent out to that borrower. This is, in a nutshell, how banks earn a profit and is the basis for their business model. What most people are unaware of is that there is far more to the lending system that allows banks to make far more money than if you were lending a friend some money in exchange for some interest payments. When you put money into a checking or savings account, the bank doesn't just sock it away in a vault underground somewhere. Instead, bankers lend your dollars to individuals and businesses looking for loans. In fact, if most people knew their money might not be there in an emergency withdrawal situation, they might question whether or not banks are a safe place to keep that hard-earned cash. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. There's a story that's often told about the origin of fractional reserve banking. Ancient goldsmiths would store precious metals on others' behalf, ensuring they're safe and ready to be collected at any time in exchange for a storage fee. Instead of storing the metals, letting them sit idle, they could lend the gold and other valuables out as a form of investment, earn a profit, and return it to the vault before the owner came to collect it. If depositors were to lose faith in their goldsmith, they could withdraw their valuables and bring them to someone they trust. This assumes that all other depositors weren't doing the same thing, thereby creating a difficult situation for the goldsmith, to say the least. In a way, this is how our modern banking system works. Fractional reserve banking is the most common form of banking practiced by institutions worldwide. It involves banks taking deposits from customers and making loans to borrowers while only holding a fraction of the original deposit amounts. Banks are required to keep some money on hand and available for withdrawal in case a customer wants to withdraw some of their cash. If someone makes a $1,000 deposit, the bank can't just lend out the entire $1,000. They're not required to keep that entire $1,000 deposit on hand, but a portion or a fraction of it. Most are required to hold on to 10% of the deposit, known as their reserve, and they're free to lend out the remaining 90%, which technically isn't even their money to lend. The Federal Reserve sets this reserve requirement as they're able to control how much money they want to be circulated into the economy by essentially creating money. Increasing the reserve requirement takes money out of the economy, while decreasing the reserve requirement pumps money into the economy. Since big banks can usually lend $90 for every $100 deposited, they have the potential to make significant amounts of interest, much more than you'd make lending some money to a family member for little interest. They don't lend money the same way an individual does. When someone deposits money, the bank pays the depositor little to no interest as a thanks for keeping their money with them, so they can ultimately write more loans. The average account interest rate is less than the rate of inflation at not even 1%. For example, a customer inherits some money, say $500,000, and they take the funds to the bank. Then, a customer comes in and applies for a mortgage to buy a home. The bank lends the homebuyers $450,000 at 4% interest rate. Traditionally, you might be wondering how the bank can make a profit charging an interest rate that's barely above the rate of inflation, when in reality, the bank is charging $18,000 per year, or 4%, for the money they lent for the home purchase, which again wasn't truly their money to lend. Basically, they're earning $18,000 in interest on the $50,000 they kept in reserves, earning them a 36% rate of return by lending money that they should be holding on to, in theory. Institutions must keep a record of each transaction, including amounts, time and savings deposits, vault cash, and any other bits of information required by the Fed, which is reported on a regular basis. Some banks are exempt from holding reserves altogether, meaning they can lend out every penny of their deposits. Banks are paid an interest rate on reserves, which encourages them to keep more reserves than they're legally obligated. Think of this interest the banks earn on their reserves in the way that you earn interest on your money you keep in your savings account. Some banks hold even more reserves as an additional safety measure in the event of a mass withdrawal during times of uncertainty, just like individuals increase their savings at times. The requirements change based on how large the bank is and how much money it has. Small banks with less than $16.3 million don't need to keep any reserves at all. Banks with assets between $124.2 million and $16.3 million only need to keep 3% in reserves, and big banks with over $124.2 million in assets have a 10% reserve requirement. Fractional reserve basically means the fraction of deposits that are held within the institution and not lent out. If a bank has $500 million in assets, it needs to hang on to $50 million, or 10%. There are pros and cons to fractional reserve banking. It allows banks to use their deposits to generate returns on loans, which would otherwise be unused and stored within the institution. This system also allows banks to make more money available for borrowers, which theoretically grows the economy. Borrowers are able to take out mortgages to purchase homes, use credit cards to buy consumer goods, and auto loans to buy new vehicles, keeping everyone happy and money flowing. Fractional reserve banking works because each customer of the bank typically doesn't need to access their funds at the same time. Although, this system could leave the bank without enough money if each depositor were to try and withdraw their funds. During the Great Depression, many U.S. banks were forced to shut down because too many depositors wanted their money once they saw the economy collapsing. This is referred to as a bank run. The Banking Act of 1933 established the Federal Deposit Insurance Corporation, which protects those customers. Even if the bank were to run into financial trouble, your deposits up to $250,000 are insured by the FDIC. It's been said that this system overinflates the economy, essentially creating a house of cards that could come tumbling down with the slightest breath of wind. This process essentially creates money and increases the supply. Without fractional reserve banking, your experience with your financial institution would be much different. The fees and interest rates they'd need to charge for lending would need to be significantly higher. They'd need to charge approximately 10 times the interest rate to earn the same amount of money. Imagine what the rate on a mortgage would look like. Instead of earning a small percentage of interest on your deposits, the bank would need to charge you storage fees in the same way that the goldsmith did. Furthermore, banks would have to maintain much higher lending standards, making it difficult for those with less than ideal credit to borrow. You might be wondering what entitles the bank to earn these kinds of interest rates. Well, if you refer back to the story of the goldsmith, resources that sit idly in a vault underground somewhere don't really provide much value. If you can put those resources to work in a productive investment, you can earn a profit and the community benefits. As long as the bank is FDIC insured, the fractional reserve system poses no risks to the consumer.